Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
Welcome to the Property Addicts Australia podcast. We are Sana and Mona Ali, the Property Twins. We are mortgage brokers and buyer's agents helping clients all over Australia build property portfolios. In this episode, we talk about your goals and risk profiles, who you need on your team to build a property portfolio, understanding the importance of correct finance setup and structuring, where to buy, your property selection strategy, which covers your negotiables and non-negotiables, whether you should buy one property or two. We also talk about your cash flow analysis per deal that's important to select a property. And then we also share about our own property portfolio decisions that we made and also didn't make and what helps our clients day in, day out. You need to look at your goals starting out with property investment. Any client who comes to us, the first thing we do is explore their goal. What's important to them about property investing? And many of them are corporate professionals doing the usual, climbing the corporate ladder. They realize that there's an income gap and they need to make a decision to get started because superannuation will not be enough at retirement to maintain the same quality of lifestyle. And as part of their goal setting, they need to consider their risk profile. Some people are comfortable just buying one property and then taking a bit of a break and then starting over with another investment property, whereas other people buy back-to-back multiple investment properties. Different approaches work for different people, so you need to make it work for you. In our own journey, the property portfolio as it grew, we took action when we could, and Sydney was stagnant at the time. For us, it was important to buy as we could, when the equity allowed, when the borrowing capacity allowed. We realized that non-advice costs people a lot. So you need to make sure you are making decisions which set you up correctly right from the start with the lending, and non-advice alone costs us millions of dollars over this time. What we find is that working with your broker, what we do for our clients day to day is mapping out our clients' property portfolios. It's not something that may be achievable straight away, but over a period of time, many of our clients go on to buy multiple properties. But ultimately, you need to take ownership and drive your goals forward. When the why is big enough, the how is easy. Having the right credit advisor on your team is not just about the loan, but what you will do in the future, because lending strategy is evolving over a period of time, right? Our clients keep coming back to us year after year, so we can keep revisiting the valuations, the equity available to them, any savings they have, how they can save on the loan, and also expand that portfolio moving forward. Then when it comes to buying the right property, firstly, there's a DIY approach. You can go and search and select and learn about buying a property. Yeah, it's possible, but it requires a lot of time investment. And a lot of our clients are actually very time poor because they're corporate professionals, they're young families. They may get help of a buyer's agent. So in terms of buyer's agents, they represent you just as a seller's agent represents a seller, a buyer's agent represents you, and a buyer's agent is actually paid by you. But you need to be really careful because sometimes there are spruikers who pose as buyer's agents, or they may say that they're a buyer's agent, but you don't have to pay them any fees. So effectively, they're paid by someone. If you're not paying their fees, someone is paying their fees. So they may be spruikers, there might be developers, agents who are receiving hefty commissions on the back end when they actually sell your property. They're not really buying you a property, they're selling you a property, and they're being remunerated by someone else. In the current market, there's a lot of buyer's agents that have been popping up in the market. Some have never bought a property for themselves or built a property portfolio. There's others who are only really focusing on one or two suburbs and really glorified sales agents in a way of that if they're buying properties for a client just in one location. So the strategy is not really tailored to you. It's just what works for them to close that cookie cutter deal for you. And they're disguising these decisions as data-focused decisions to cover up on quality property selection or quality location selection. And that's really concerning because then they're finding 30 or 40 of these houses in a month. And we believe it's not possible to buy 40 quality properties in a month.
And you have to then wonder, though, are the corners being cut? Like you're investing hundreds of thousands of dollars. This is maybe your life savings. And who gets the best deal out of the 30 or 40 clients that they may have at any one point in time?
Or is it a factory?
Is it a factory? Yeah. A lot of the volume-based buyers agencies are like factories, and they disguise their decisions based on data. Whereas, effectively you need to look at a lot of factors, including qualitative factors, and even up to picking a quality house. And often some buyers agents would disguise it as under market value properties. You have to wonder, if a property is under market value, is there something actually wrong with it? And when you come to selling it, would it always be under market value? Sure, it's possible to buy an under market value property, but you can't buy all properties under market value. Market value is what someone is willing to pay for a property on a particular day.
Where do you sit in the list of these professionals, really? So you need to really make a decision on who you're working with. Are they boutique or are they selling on a mass scale? And then you need to have a really great solicitor on your team, because you need someone to review those contracts. And also, if things do go pear-shaped, be there for good advice so you can take your deal to settlement. Also discuss the sales process for the state you're buying in.
That brings me to the saying that whilst we can tell you a cost of doing something, we can't tell you the cost it will be should things go pear-shaped, really. So you need to really weigh up. It's often you don't know the price that you may have to pay by saving a few dollars.
Yep. And then a building and pest inspector, I've seen clients not do building inspections on properties, and that really scares me. You need a great building inspector on your team or a strata manager if you're buying a strata property. It's important to get on the phone with you once they've done the inspection and go through the report page by page and ask them, would you buy this property or would you actually walk away from this property? Sure, there might be older houses which were built in an era where they all have the same issue, but look for major issues which could cause you problems down the track with property maintenance or even when you come to selling. And then a great property manager. You need an awesome property manager on your team because you want good tenants who look after your asset, where you're maximizing the rental income you can receive, and that your property is looked after over the longer term. A bad property manager could end up with the bad tenants and a trash property, which, I've experienced personally in my own portfolio and journey.
And lastly, you need a good accountant, a property accountant on your team who can help you navigate the taxes, help you with any tax variations over a period of time, effectively helping you manage your cash flow over time. One of the key decisions that you will make in your journey is about finance setup, or how you're going to finance your investment property portfolio. We find that often people think of property first and finance later, whereas finance is fuel for a property portfolio. So you need to set up your finance correctly, know how far your resources can go. Are you able to buy one property or two properties? Should you be paying lenders, mortgage insurance? And effectively mapping out that portfolio based on your resources upfront, because that will put you in the box seat when it comes to your property search, because you will know exactly what you need to target.
And then lender selection is an important one. People often think you choose a lender based on the interest rate, but actually, no, you choose a lender based on their flexibility, them releasing the equity that you can to invest in property. Some lenders won't release any equity or would want to control the equity. So the right lender is important with that. And also valuation shopping. That's what we do for our clients on an ongoing basis, looking at various lenders and seeing where they can maximize the equity in their property to buy multiple properties moving forward.
In terms of lender selection, we go to lenders in a particular order. So if you would like to build a property portfolio, it's vital that you choose the right lender at the right point in your journey, because each lender has their own borrowing capacity and lenders are in tiers. So you want to maximize your borrowing capacity with top tier lenders and moving on to mid-tier and then lower tier lenders. And this is navigated over a period of time. Just because you bought a property with a lower tier lender doesn't mean that you will always be stuck there, because as you may know or may not know, that with lower tier lenders, you do pay higher interest rates and all, but sometimes it could be like a timing thing, like a lender for a period of time. And then when lending loosens up or policies change, you can refinance to a top tier lender. So you need to navigate this over a long period of time.
Consider the repayment types that you will go for, principal and interest versus interest only. Often when we're talking to clients, even clients who are not our finance clients, they don't have the clarity with what they're doing, what they're paying for them. And often we end up having a finance discussion with them, because what you need to consider is, my goal is to pay off my home in the first instance, and that's your non-tax deductible debt. So should you be paying P&I or interest only? Talk to a good tax accountant and also get credit advice on how to set that up so you can move forward. And also consider the power of lender's mortgage insurance. If you could buy one property or two, what would give you more exposure to the market? But you do need to consider your risk profile before doing that.
Yeah, and also touching on the repayment types, what you were referring to earlier, with repayment types like interest only versus principal and interest, you need to really consider that, because it needs to tie in with your long-term goal, what you're trying to achieve. Because one path could mean that, you end up paying your owner-occupied non-tax deductible faster than you could have otherwise. Also, you need to make sure that it's all done very tax effectively. One of the last things and the most important things that you need to be wary of, high-risk loan structures. So what I understand is some banks actually encourage their bankers to put clients in high-risk structures. That includes cross-collateralizing your properties. That means tying your properties together. People lose out, especially in a downturn market with that. By cross-collateralizing, you're effectively giving bank the control. You'd be stuck, unable to refinance to potentially a lower rate. If valuations fall back, or if you have to sell a property, then you're stuck. Really, you'll have to make up for that shortfall in the lending side of things. So I'd highly encourage you to explore that. If that's how your loan structure has been set up, you need to really pay attention to it.
Because as you said, right, lending can tighten. I've seen clients with cross properties with a lender, and they're trying to refinance one property. And this existing lender is saying, we are going to value both properties. And if the valuation on your home comes short or your investment property comes short, we're going to take some of the equity, or worse, not even let you refinance. I've heard of stories where people have even tried to sell one of the properties of the two, and the banks come and valued the properties, the property that's remaining with the lender, the valuations come short, and the bank has kept the profits for that property sold. So the property owner has not even seen any benefit of that investment, because the bank's taken dibs over the equity and the profit gains.
Having a bad loan setup, loan structure, could mean a difference between you being able to expand your property portfolio or staying stuck effectively. So you have to weigh up how much flexibility you have, and if you feel that you've been tied up. And the way to check that is you check your loan contracts and see if both properties are actually listed on the loan contracts. And, sure, it may be easy for a broker or a banker to do one application and tie the properties together, but it's not an issue until it's an issue.
Yep. So if you are listening to this, then review your loan contracts and make sure your structures are low risk. The next decision you'll make is where to buy property. Australia's got many markets, and there's 15,000 odd suburbs in Australia. So where should you be buying? The first step really is understanding the property cycles. There's markets within markets, and all capital cities are at a different point in the property cycle. So we've seen that with Sydney booming, followed by Brisbane, and then Perth.
When you are narrowing down on a location, you may utilize various data sources. Obviously, there's paid data sources and there's publicly available data sources, which look at the supply and demand metrics, renter to owner ratios, current rental yields. It might give you an indication of current rental yields, but you'd have to obviously delve into the data and look at, actual live data and work that out. You'd look at the rental vacancy rates as well. So you take all these bits and pieces and put it together. And you may also look at historical data, which may be available on sources like Price Finder, which may give you 20 to 30 year capital growth or negative growth data, and you can analyze that to see at what points the market may have had double-digit growth, and also look at when it has had negative growth. So it may give you an indication of where things may be heading there.
Yeah, and with the growth about to happen, what we've seen is rental yield is high on those properties. So rental yield is inversely proportional to capital growth. And when the rents are high, it attracts investors to the market. Any renters, they start considering it's cheaper to buy our own home than continue renting. And that's followed by increased competition, increase in prices. And that's what we are seeing in Perth at the moment. Following this, the rental yield reduces as the prices rise. So you might have bought a property for 500K, renting for 550 per week, and as capital growth happens, it might be worth 600K and still be renting for 550K, so 550 per week. So this cycle continues. The rents rise, then the capital growth happens, then capital growth happens, and then rental yields drop. So keep following that, and it's a great indicator to know if a market is poised for growth. You need to also see the rising tide lifts all, right? When a market's rising, everything rises. So that doesn't mean a badly located property would be a good addition to your portfolio. So be mindful of things like a property backing a main road or a train line, or being affected by floods or bushfire hazards. So when booms happen, people just go crazy and willy-nilly just buying anything just to get their hands on the property. But the true test is, would you be able to sell this property in a downturn, in a down market?
Yeah, that's right, because property is not a liquid asset. So you need to make sure that you are avoiding big mistakes. So hypothetically, at a future point in time, you may decide, oh, now it's time to sell this property, but that market is no longer booming. So you need to just make sure that you are buying a property that would still be in demand by buyers in another market. But say hypothetically, you're buying something and you're just buying it for the sake of buying it. So you need to make sure that you're buying the right quality of asset, because property is it's not a liquid asset. So hypothetically, you buy something in a rising market, then a downturn comes along and you would like to sell that property. You need to make sure that that property will be in demand at a later point in time. Whereas on the other hand, in a rising market, if you jump in and if you buy a lemon and down the track you want to sell that property, the questions that you had or the issues you had with that property originally would be in the minds of future buyers as well. So you need to make sure there's resale value with anything you buy.
So there's data, which is great, and looking at property cycles, but there's also the qualitative factors. What are the fundamentals? What's happening in the area? What are the projects? Is the government investing any money? Is there any retailers? Is there private funding that's happening in the area? What would create more jobs? What would attract more residents to the location? That's a great indicator, because if these companies have invested the money in doing the research for an area, then they know what's coming, they've done their research. Then that moves into the property selection strategy, tying where to buy with a quality property. That's where the property selection strategy comes in.
Once you know where to buy, then you look at your property selection strategy. So that involves you coming up with your negotiables and non-negotiables. It's important to have a clear property selection strategy, because if you don't have that, then all houses look the same. So as part of this, you would look at, should you be buying brand new or established property, a house or a strata property, how big the block would be, what the age of the property, like are you happy to do some cosmetic renovations to this property, or do you want to set and forget property, how big the block should be, like are you looking at future potential of the block, or you prefer a newer property on a smaller block which is very low maintenance. So you have to weigh up all those things. There would also be things like, even number of bedrooms or bathrooms. You really be very, very clear on that on the front end. And also, if you are looking at a particular area, like where should that property be located within that area as well.
And also maximum purchase price and rental return that you'll be expecting. Tie that in with your finance strategy and your pre-approval, so you know you're sticking to your budget when you're searching for these properties.
And I would also encourage you to also look at any deal breakers you may have. deal breakers around, well, the property should not be backing a train line or a busy road or on a busy road, or is it right on a roundabout, or is it near a commercial area? So you need to really have a clear understanding of the deal breakers. So when you see a property that doesn't meet your criteria, you discard it, you don't waste time on it, you focus on other deals.
As part of this property selection strategy, also leverage the council and state available data on any environmental hazards in your chosen location. This could cover floods, cyclones, bushfire hazard in the area, and also look at publicly available information around the easements on the property, especially if you're buying a big block and it's affected by, say, a sewer line. You can't do anything with that property. Make sure you put that on your negotiables and non-negotiables list, because once you've bought the property, you're stuck with it and you have to live with that decision.
Another key decision you'll make on your journey is if you should be buying one expensive property or spread the risk between two properties. So it will come back to your finance strategy that you have worked on with your broker, because say hypothetically you may have a budget of just $700,000. Now, should you be buying two $350K properties or just one $700,000 property? On the other hand, you may have a $1.2 million budget, which can be spread across two $600,000 properties. So there's a number of permutations and combinations that you can go through in terms of deciding what you should do. But always focus on quality, not quantity. It's not really the number of properties that you buy. Whilst, there are some pros and cons of both approaches, but it's all about quality, a property that will set you up for the long run. And just something that you need to be wary of is, if you are buying in a lower quality price bracket, you may have challenges which you may not have in a higher quality bracket in terms of tenants.
Yeah, but there's pros and cons to both approaches, right? One property versus two. If you have, say, a $1.2 million investment property, when you have vacancy, you're paying the entire mortgage. As opposed to when you have two properties, you have rent covered for half the mortgage from each of the property. But on the flip side, with two properties, you have two council rates, two water rates. Even acquisition costs, right, are higher when you're buying two properties as opposed to one, because you're getting legal advice, building inspections, etc. The plus with having two properties is you could sell one down the track and pay down the other one, or at least have some exposure to the market, and it's easier to liquidate as opposed to a more expensive property where you sell the whole asset. You can't sell half the house.
Talking about quality versus quantity, or buying, say, quantity, like say hypothetically buying multiple properties in a cheaper location, you just need to be wary of, if some of these markets are just primarily driven, say, hypothetically by a number of buyers agents just buying in that area. So they could be artificially inflated pricings in these areas. So say when these buyers agents stop buying there, then what happens to the value of your property? So they might be artificially increasing for a period of time, but now they've left the market. You may end up with a lemon effectively.
Yeah. And, expensive or cheap is really subjective, right, for every individual in terms of what they buy. Just make sure you're buying a quality property in a quality location with future for both capital growth and cash flow, and you won't go wrong with that. You need to balance capital growth with cash flow if possible. And that has been our strategy and many of our clients' strategy over the years. So having the best of both worlds, because in an interest rate cycle, right, you need to be able to manage the repayments as well as your lifestyle. So you need to look at the numbers very closely and get advice on it, really. And those are the types of conversations that we have with our clients. So talking about a client, right, where they could have bought one more expensive property, one cheaper, and the implications of cash flow, right? I want to talk about our clients, Rob and Emma. So Rob and Emma had a home loan which was fixed and they could tap into the equity. So we tapped into around $350K equity from their owner-occupied property, and they could take two parts. They could have bought a more expensive $800K property in Southeast Queensland and followed by another $500 or $600K property. They had enough serviceability to do both of them, but risk mitigation and cash flow was important to Rob and Emma, and that's where we went and bought them their first investment property in Western Australia instead for $560K, renting for $550 a week. And what that means is they have used maybe about $150K odd of their equity cash out, but they're still left with another 200 grand. So they can either choose to buy a more expensive property or buy another cheaper property. If anything, they're borrowing, and based on the equity available plus their own personal savings, they can buy easily another 2 investment properties after this cheaper first one.
It's obviously come down to decisions around the right finance structuring from the start. And they're now set up. They've not only bought their first investment property, they could potentially add another 2 properties through correct finance setup and property selection.
That's right. And the property selected has been purchased in a high growth market, rising market. So they will soon have equity for maybe even more properties that they might be able to add down the track to their portfolio.
As part of your property journey, one of the key decisions you'll make is the cash flow that you're comfortable with. So you will look at cash flow around the outlay that you need, the deposits, stamps, legals, and you would also consider if you're actually paying lenders mortgage insurance. That's a discussion to be had with your mortgage broker.
And then analyze cash flow deal by deal. So you need to look at what your rental income would be on the property and what would be your expenses, right? Like your mortgage repayments, the property management fee, any landlords or building insurance that you'll incur, any package fee for your lender. Subtracting the income minus expenses should give you your net position. And then also, of course, subject to your tax accountant advice, you might have some tax benefits. Then you can determine what the property is going to cost you on a weekly, monthly, and yearly basis. So we've run this cash flow on thousands of deals, starting with our first property. And I just want to share, Mona prepared a cash flow spreadsheet 14 years ago that we're still using. We give away this to our clients and also in our Property Addicts Australia Facebook group, where you can run your numbers and determine what the property is going to cost you to hold.
And it's been very beneficial even to non-clients of ours, people who are not really working with us yet. And they have reported back that it's been very helpful in their journey. So if you don't have access to it, you can join the group and get access to the spreadsheet.
Analyzing cash flow would also tell you if the property will be positive, neutral, or negative. What that means is positive, it puts money in your pocket. Neutral, it doesn't cost you anything to hold. And negative, there is cash outlay. But of course, that's a function of interest rates. As interest rates are a bit higher, most properties would cost you something to hold. But this could change as rents increase. Make sure you also have some buffers built in for maintenance and property costs in an event of vacancy. So your property is looked after even when you don't have tenant. Property is a business and cash flow management is an essential part of maintaining a property portfolio.
In our own journey, we went through a number of key decisions. So firstly, we considered if we should be buying a brand new property versus established properties, and a decision was to go down the path of buying established properties. We looked at strata properties because we had limited resources when we started out. So we looked at strata properties with a bit of a land component like townhouses and villas. We wanted to make sure that the properties were high yielding because we wanted to make sure that they weren't impacting the quality of our lifestyle. And also we made the decision to take decisions as and when we could. We didn't wait for someone to tell us to take action. We took action as and when our resources allowed us to.
We did also explore at one point, right, granny flats and buying a block and subdividing. And, all these are great strategies, but often they end up distracting people from their actual goal. We did not go down that path, by the way. We did not go subdivision or granny flats, but instead what we said was we are going to buy as many properties as we could and when we could. As part of that, we made a decision to pay lenders mortgage insurance because that helped enable us to expose ourselves to more properties and more assets.
Yeah, and one of the key decisions actually that was a game changer was jumping in a rising market. In mid-2013, when Sydney market started rising, we could have given up with fear that, there's a lot of people at open homes, but that was only the beginning of the cycle. So we jumped in and bought a couple of properties at that point in time, which actually paid off really, really quickly as well.
We realized as part of this process though, right, finance was really important because if we don't have the right advice with the finance setup, then we can't move forward. And unfortunately, we had the non-advice or bad advice. But in hindsight, it was a huge realization that you need to select lenders in a given order and be very prudent in the actions that you're taking. And coupled with the right property selection. Yes, we started with strata properties, but then we moved on to houses because land, they don't make more of it anymore.
Lastly, the key was buying properties that were actually well located, close to infrastructure, which will always be in demand with tenants and future buyers as well.
But our main decision was taking action as and when we could, not taking no for an answer. Action is always in the present moment, and with clarity comes certainty.
Thanks for listening. Join us next time for another episode of Property Addicts Australia podcast.
Thanks for listening to Property Addicts Australia. For future episodes, click follow. Leaving a review helps others find the podcast. And for more information about how we can help you, visit propertytwins.com.au.